self-taught since 2017. I had no mentor, no blueprint. I've created 7 millionaires and counting since 2019. This is Infinity Loop. Let's get into it.
High price is always going to be at the top. Low price is going to be at the bottom. Open at the top, close at the bottom. So with bearish candlesticks, they will start high and then they will close low. With bullish candlesticks, they'll start low and then close high. If that makes sense, right? So one's going to be red, one's going to be green. It can be yellow, purple, or orange if you like, depending on which you change the colors to. Just make sure you understand what the colors mean to you if they're not red and green. So in some of the charts, you'll see that there's different types of wicks on different candles. Sometimes there'll be longer wicks, sometimes shorter wicks, and some candlesticks might not have any wicks at all. All the wicks mean is that price tried to go into that area, and then it took away from that area as well. So when I say wicks equal rejection, that's what I mean. It means that our opening price tried to go higher. It's open right here. Let's act like this is 140. Open at 140, tried to hit 145. Rejected off 145. The open is still at 140, correct? So then, since it can't beat 145, you get this wick that's formed. Then it tries to go lower. Let's say this is 140. Let's say this is 135, and let's say this is 120. Tries to go to 120 after rejecting 140, and guess what happens down here? It rejected 120. That means it decided it's going to meet in the middle at the close at 135. That's all wicks mean. Wicks just mean rejection. And it tells me where price doesn't want to be. I play that a big part of my trading because if I know where price doesn't want to be, and I'm looking at the most important wicks in the whole chart, then I'm like, okay, once I get a break or a retest above or below the wick, which would be acting as my support or resistance, that's telling me, okay, once broken, all I'm looking for is some confirmation for it to go ahead and continue further up. Without confirmation in price action trading, there's no trade. So let's talk about risk. Risk is going to come from being disciplined. Risk is important because it's going to really make or break your account. You start off with too big of a risk, coming freshly new into the game, it's going to ruin your whole experience. But my students personally, I tell them to start smaller because there's no point in trading a large account if you aren't able to keep up with lots with pips, with lot sizes. If you can't even call your own trade, there's absolutely no reason that you should be over leveraging anything in your life at that point in time. So you know how you start riding a bike and they put you on training wheels. This is ultimately what lot sizes are. 0.01s, everyone hates to trade them because they're slow, and typically they're going to go into profit a lot slower than the 1 lot or the 50 cent or the 20 cent. This is going to be the slowest moving lot size, but they're for lower account sizes because say if you start with a $100 account and you have a 0.01 lot, then you're not really losing much if you're in a 30 pip drawdown. So say if you're in a 30 pip drawdown, you have $100 or $200 or $500, so on and so forth. This 0.01, you're only going to be negative $3 on a 30 pip drawdown. On a 30 pip drawdown for the 0.05, you'll be down $15. On a 30 pip drawdown on a 10 lot or a 10 cent lot, it's going to be $30. So me personally, when I'm entering trades, I'd rather scale in first with the 0.01 because the 0.01 is not going to be taking as heavy drawdown as my 50 lot or my 1 cent or my 1 lot. If you're in 30 pip drawdown on a 20 cent lot, that's going to be $60 at your drawdown. You're on drawdown on a 50 cent lot for 30 pips, that's $150 that's going to be drawdown. And then on a 1 lot, a standard, that's going to be 300 pips drawdown that you have to take if you enter the trade too early. So that's why I always recommend scaling in first, seeing where the market direction is going. Once you get that second or third confirmation, then you add on heavy. So it's almost like, you're riding a bike, you start with the training wheels, and then you just slowly start taking the training wheels off after a couple weeks. Once you can see that, okay, I haven't fallen off my bike in like a week and a half, 2 weeks, 3 weeks. Let me go ahead and take these off. That is what the 1 lot is for. It's not meant for you guys to stay on for the rest of your life because me personally, I think after 6 months of trading, you should really just be off the 1 lot, the 1 cent lot. Because like a lot of retail traders, and that's what most of you guys are until you are able to successfully trade, they have problems just entering the market for whenever they want to enter the market. Meaning they're overexposing themselves when it's not necessary to, because they're like, okay, well, on one side, I'm not really losing anything, but you're also not really gaining anything either. So while you're perfecting your strategy and trying to find a way in order to become successful and markup charts, so on and so forth, and test trial your own strategy with trial and error, you need to be on one set. But once you are able to consistently be profitable with a 1 cent lot, because it does take the longest to be profitable, then you start moving it up gradually. And if you can consistently, say you don't blow your account for like 2 weeks and you're on a 10 cent lot, okay, cool. You ain't blowing your account in 2 weeks. Let's go ahead and move it up to 20 cents. 2 more weeks, you're still ain't blowing your account. 3 weeks, you ain't blowing your account. All right, cool. Let's go ahead and move it to 50 cents. Some of you guys are starting out the gate with 50-cent lots and standard lots because trying to compete with me. But I want you guys to understand as well, I'm in my 4th and 5th year of trading. Like, I'm fine with people over leveraging, but you better make sure that you have a damn good setup if you're doing it as well. That's all the advice I'm gonna have for you. Ultimately, is you guys' account, just manage your risk. I try to stick to a 30 pip stop loss max, because I feel like with the smaller stop loss, you're able to recover more, recover a lot better than having a 80 pip stop loss. It's kind of hard to recover an 80 pip stop loss because typically it's going to take your entire account if you don't plan that out well. Moving on, every single chart starts as a blank canvas. So here is going to be my trading view. This is just a picture of my trading view that I shared with you guys on this slide. But every chart on trading view is going to start like this. It's going to have absolutely nothing on there. It's going to be our job to break it down in order to find where we want to execute. Because just think of the market as being one big mess. And with that being said, you just want a little piece of the mess in order to make a really good money. So say if, okay, we're in an uptrend, cool. We're looking for a reason to buy since we're in an uptrend. It only makes sense, right? So would it be smart to either buy high or buy low? Smart to buy low. So any retest you get in an uptrend to where we've already considered, decided that we're in an uptrend. So why buy green when you can buy red candles, right? Because we are in an active uptrend. It's your job to break that down, and I'm going to show you how during this presentation. All right, so market structure is really, I would say, the keys to the street. Like, you can make a ton of money just knowing market structure alone, and as long as you know there's 3 different ways the market can go, it can either go higher, it can go sideways, or it can go lower. There's nowhere else the market could go. There's no secret doors that the market can go to. There's no curtains. There's no Wizard of Oz. It's literally up, down, or sideways. It's the only option it gets. So that's why I want you guys to stick to our higher time frames, because if you can already conclude that, okay, I got 3 options. Is it going this way, this way, this way? If it's going sideways, it's already, you already know what you're supposed to do. You don't enter the trend. If it's going to be an uptrend, okay, identify the base, and the base is down here. All right, now after the base, which is the low point, I need a high point. This is my high. Okay, after the high point, I want a low point to buy again. So this is my low. So this would be a higher low versus the low. We call this the higher low because it never took out this low. Had this low taken out this low, it would have been an invalid uptrend, because in a typical uptrend, a uptrend will never make a lower low. A downtrend will never make a higher high. So which brings me over here. So we have our high point in our downtrend, correct? And then we have a low point in our downtrend. And then we go back up to make a lower high. The lower highs will be what you want to execute on. Not necessarily the highest high, but you can if you like. But me personally, in order to take a safe trade, I like to execute on the lower highs, because that's going to give me confirmation of, okay, I've had my high, I got my low, I need a lower high to execute. My stop loss will typically be above the high, because in a true downtrend, a downtrend will never get a higher high. If it does get a higher high, it's invalid. So that's something I want you guys to remember as well. Now this chart here, which is re-referencing with more candlesticks and, in the line chart formation, that what I was saying earlier, you never want to buy high. You always want to buy low. You never want to sell low. You always want to sell high. If you are selling low, just be cautious about it, because if you're not aware of your surroundings, depending on the time frame, it's just going to leave you ass out, basically. So as you can see, all the green points in the market on this side, we're in an uptrend. All the green points are buying opportunities, because we've already identified, okay, this is my low, this is my high, this is my higher low, because it never took out this low here. Now, if I see that this is my high, and what's the rule when you have a high and you got a higher low? You have to make a higher high. So all the red points are selling points. If you're trying to, if you're trying to take both sides of the market, which I don't recommend, but some people do anyway. If you have this being your high, your next level of execution is either here on the low, on the higher low, or it's going to be here above your high. So that's when I say break, retest, trade. Go back. There it is. Okay. So this will be an example of, this is the highest high. If I buy at the higher low, I'm looking for this higher high to be taken out. So I want to break this resistance, which is where the high is. It's coming from resistance. This is the demand point. I want to break the resistance or the supply zone and make it a demand zone, and then buy it up again, take it to a new highest high, and then execute off of the higher low and take it to a new higher high, because every single one of these red points are at supply zones or resistance points. Every single low point is at demand zones or support points. If you have a breaking structure, such as this middle line right here, to where this was acting as demand, but you get a break, retest, and then a trade, now it's acting as supply. So each one of your lines that you guys have seen me mark up on the charts, especially coming from the monthly or the weekly time frame, you never know what the horizontal lines are going to act as until you get down to the lower time frames, because each horizontal line, even though you're placing them on resistance points off of the monthly and weekly time frame, they can act as supply and demand. So it's your job to make sure you know properly what is this chart doing. So that's why I always say break, retest, trade. My break is going to be an impulse move. My retest is a price correction, and then I'm continuing my impulse move. Same thing with up. A break is going to be an impulse move. A retest is going to be a correction, and then I'm continuing my impulse move for the bullish if we're in an uptrend, and bearish if we're in a downtrend. All right, so let's look at some live examples of everything I just told you as well. All right, so we're going to look at the chart of Euro MXN. While looking at Euro MXN, we have a low point, which I pointed out to you guys, this is going to be our base point. After the low point, if we're considering an uptrend, we need a high point, correct? Our high point is going to be here. And then in order to execute, we would need a higher low. So with that being said, you can execute off of a low point if you like, because it's still giving you the same thing. I don't know if you can see the green that's right here. The three green lines are going to be a break, a retest, and then the trade. That's all you look for every single time. So everything that you see on a higher time frame, you can come down to a lower time frame as well and see it as well. Right here, we're just looking at the monthly, and we're establishing trend. A higher time frame trend is going to mean a lot more to me than a lower time frame trend. So just because something has went down for 3 days in a row, and say the weekly isn't broken or the monthly isn't broken, I would say the trend is still up or the trend is still down until we get those fractal breaks coming from the higher time frames. Then we can start transitioning into the opposite trend, but you would need confirmation. Our goal is to trade the market. Our goal our goal is to trade the market and analyze where we think it might go. Our goal is not to try to force the market to move, because let me tell you, we don't have enough money to move the market like you think you can with your mind. I can't even move the market, and I have a good amount of money coming from the market as well. We want to move with the flow of the market, not against the flow of the market. So if the market is telling you it's in an uptrend, believe it, because you're going to be a lot more profitable that way than the other way. So we have the low, higher high, the low, the high, the higher low. Higher high takes out this high, and then guess what? We need another higher low. Takes out this higher low. Stays above this higher low. Then we go a higher high again because it takes out this high. See how we're still in that trend, because we're always continuously getting higher highs and continuously getting higher lows. There's not any low points or high points that can close beneath here, or can close beneath here, or can close beneath here, or can close beneath here. It's impossible. It's against the rules. So you got to stay with the trend, and you can see, you identify these three, you know the rest of the trend. Same thing, and that's what it is here. So if you can identify these three moves, then you know where the rest of the trend is going to go. And now this here, as you can see, this trend started way back in 2003. The trend didn't break until 2009, and here we are in 2021, and the trend is still valid up until currently, where I feel like it's going ahead and starting to break into a downtrend, which is good for us, so on and so forth. Now, for a bearish trend to start, you have the same thing, except it's the opposite. Instead of a low point, you have a high point. Instead of a higher high, you have a low. Instead of the higher low, you have a lower high. So don't get those confused. Take the time to know what a low, a high, a higher low, or a high, a low, and a lower high. Don't mix those up, because it's going to throw your execution off. As long as you have these three, you know what the rest of the trend is going to do. The lower high is going to be your execute point if you're selling the market. So that's why people say buy high, buy low, and then sell high. In this point, we're starting a bearish trend because we have our three confirmations here. Now, since you couldn't sell this low unless you did, which is good if you did, but if you're looking for a new entry, the lower high would be your entry. This lower high would be another entry. This lower high would be another entry. This lower high would be another entry, so on and so forth. So if you're a swing trader, after only having these three, you would have caught this entire move here, which is good for you. Now, me personally, I think I've told you guys before that I'm an intraday swing, meaning I come with swing tendencies because I do come from the higher time frames and then execute off of the 15-minute or the lower time frames. But you can take it as is. Typically, swing traders, I would say they don't use high lock sizes, because you got to be able to understand that the market doesn't move in a straight line. So if you're swinging with a 0.01, and maybe for an intraday to where you're swinging 0.01, well, say you put a 5 lot on there for intraday, so maybe 3 days out the week, you're swinging a 5, but then at the end of the week, you're taking profit on that 5 lot. That's something that I do. I do that. I don't necessarily swing the 5 lot from January all the way until October, because that just doesn't make any sense to me personally. And plus, I like faster money than having to sit there for 8 months at a time. Now, drawing trend lines, it actually helps you too, knowing where exactly the trend line is touching, because the trend line touch can also act as support and resistance, or supply demand, same thing. Supply and demand is going to be zone, support and resistance more one price. So make sure you guys know the understanding of that, and we're going to go over a little bit here in the video as well. So as you can see, this is the same chart setup for the Euro MXN on the monthly time frame that we have that I showed you a little bit ago. Only difference is I added a trend line to it. Notice every single fractal that touches this trend line, and a fractal is going to be a entry point or a buying point in this case, because every fractal that hits this trend line, the trend line acts as support. If it breaks under it, that's a stop loss. But more times than not, this trend line acts as support, and every time you get a touch of this trend line, you can go ahead and buy the trend. And then the trend line is just guiding structure, because even here, like looking at the low, higher, high, higher, low, higher, high, higher, low, higher, high, so on and so forth. Even looking at that, there's market structure, and then there's structure of the market. Now, all these highs and lows that you see, this is structure of the market. So identify the structures of the market and then be able to execute it once it gets to that level. So that requires you guys being patient with not only yourself, not only with your mind, but with the market in general. We don't want to necessarily trade ranging markets, but we do want to trade trending markets, and that's the goal. So trade trending markets, ranging markets, you leave alone and look for the next best setup, because you're only as good as your next setup. Market highs and lows on the week. So say if you're starting a new week and you're looking for the market to continue an uptrend or go into a downtrend, whatever your bias is, you still want to make sure you understand what the highs of the week and what the lows of the week. Those can be found body to body. As you can see, we're on the weekly chart here, and we want the weekly high price and the weekly low price. So once the new week starts, as you can see here, so say if we're looking at sales for Euro MXN, we have our high of the week was 24,447, The low of the week was 24.26. If I'm looking for sales, I want it to stay below the last week's high, if that makes sense. And if you're looking for buys, you want it to stay above last week's highs or last week's low. Now, this little tiny sliver of green that you see, that was when I made this chart. We're in the beginning of a new week coming up, so you don't get the full body of the candle yet. But that's because I measured the blue line is my high of last week, and then my red line is the low last week. So just make sure you stay in tune with that. I like to really just reference it. I don't use it in my everyday life of my trading, but I use it as a reference just so I can kind of reference myself and know it's like, okay, we're still in this uptrend, or okay, are we going to get some pullbacks if we are in this uptrend now? Yeah, we're in an uptrend, but you can still get pullbacks in the uptrend as long as your uptrend red candles don't outweigh the green candles, and as long as your downtrend green candles don't outweigh your downtrend red candles, if that makes sense. So same thing. If you're measuring the dailies, highs and lows, it's going to be body to body. The way that we start our trading each time on the monthly and the weekly, we do wick to wick. And if you're marking the highs and the lows just to reference yourself, it's going to be body to body. So body to body is going to be not the wicks. These are 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 bodies. So you want it to be right on top of the body. Right on top of the body, right on top of the body, right below the body, right below the body, right below the body, so on and so forth. All right, and that brings us back to what we just discussed also. If you're in an uptrend, are the trend lines touching the bottoms, the low points, or the high points? If it's touching all the low points and reacting off of it, such as retest, trade, retest, trade, retest, trade. If you're touching all the low points, it's buying opportunities. Opposite for a bearish one. If you're touching all the high points, it's a bearish opportunity. So low points are going to be bullish opportunities. High points are going to be bearish opportunities. So every lower high, you're going to be executing entries off of because you're in a downtrend. There's no reason to start buying just because you see all these green candlesticks when you've already identified that you're in a downtrend. Just make it make sense, guys. Like, trading is hard. I know a lot of people have been gurus for a long time and they told you all the wrong things, but it's my job now to get you guys to start thinking the right way. And the right way is going to be the charts. The charts cannot lie to you. Gurus lie. Charts do not lie. And that's why I focus on technical analysis. All the news in the world. When I bought NEO, we were in the middle of a trade war. It's going on, Everyone was like, oh, I'm not messing with Chinese stocks. All this is going on. But guess what happened? The chart didn't lie. NEO took off. It was time to buy. All the big investors, they hide the secrets in the charts. So you guys remember that. Every consolidation is going to be a consolidation zone, and it's going to be a sideways market or a ranger market. There's so many words for it, but anytime you see this, that just means don't trade, guys. Like, I would say the thing that always got me, and it took me so long for my learning curve, was when I was a new trader, I always felt like I needed to be in the market just because the market was moving. And that's not the case. Like, you guys don't have to be in the market every single time that something moves. Like, everything in the market is not shiny. So you guys have to start, strengthening your mind to know that, okay, not everything in the market is shiny. So I don't necessarily need to be in the market at all times. I just need to be in the market at the most important moves. If I know that I react off of breaks and retests in the market, such as breaks, retest, trade, then that's what I'm going to do. All this in the middle, I'm not touching this in the middle because that's ugly and that doesn't make any sense to me. And consolidation can happen on any time frame. So it's your job to make sure that you're not just sitting in consolidation for the entire rest of the day, because not only does consolidation and you being in consolidation messes with your trade, but it also messes with your mental as well. And like I said, you're only as good as your next trade. So if you lose your trade because you got stuck in consolidation, guess what that's going to do? It's going to mess up your psyche too, because the next time you get into a profitable trade, you're just going to take profit as soon as possible. And like, come on, guys, that doesn't make any sense to me. So we're going to stay out of consolidation. We're going to execute less and we're going to study more. And that's how you become a profitable trader. All these indicators and I forgot what they call it, that little window that IML got or Trader or Epic got, that be like, oh, the harmonic scanner, all that. You don't need that, guys, because I can measure the strength of pairs coming from just technical analysis alone, and that's what I'm showing you guys. You don't need to pay for another indicator in your entire life. You don't need to go to any other trading groups because the charts hold all the secrets. You just have to be disciplined enough in order to be able to want to learn charts and read charts. Yeah, we're all here to make money and be profitable traders, but ultimately we need to learn how to read charts in order to be successful in the market, because fundamental analysis is going to be news trading. So I know a lot of traders that are news traders, but really those news traders, they enter the market wherever there is. Like if they hear, okay, DKNG is about to go big in New York, so on and so forth, or something big is about to happen with sports betting, then they start buying DKNG. But in reality, once you hear the news, typically it's too late. You'll see technical analysis months before you even see the news come out. So that's why I like technical analysis. Cannabis, TLRI, ACB, Hexo. I was buying all that when it was less than $1, and look at them. They're starting to breach $20 at a time right now. One's at 10, one's at 20. I think another one's at 30 or $56. You're going to see technical analysis time and time again, way before you even see fundamental analysis. Fundamental analysis is really just our catalyst and our boost to profits. Like the fundamentals, I count it as a reward. I'm like, thank you for rewarding me and giving me all this money, because I've been so patiently waiting for this trade to go into profit, for this stock to blow the top off, so on and so forth. Now, trends, and the rules for trends are going to be that 2 candles make a trend, 3 candles are confirmation, and trend lines can apply to all time frames. So you can draw a trend line on any time frame that you want, as long as you know the highest time frames are going to be the most important trends or trend lines being drawn. They provide strong confirmation, and when a trend is broken, or supply and demand is broken, or support and resistance is broken, that means it's getting ready to form a new trend. That doesn't mean execute just because you see the break right now. That means wait for a break and a retest to be respected. When I say respect, I'm looking for retests, so on and so forth. Make sure your trend line stays intact with market structure, whether it's short term or long term. So whether you're on the 15-minute time frame, or the monthly time frame, or the weekly time frame, or the daily time frame, comparing the 15-minute time frame. The 15-minute time frame may tell you, okay, it's time to sell. But if that daily and the 4-hour time frame, or in the higher ones above that, if they don't tell you it's time to sell yet, that means the 15-minute time frame is temporary. Like you have a couple minutes, maybe 30, 45 minutes out of the 15-minute time frame in order to be profitable. Now, if you find a trend on the 15-minute that's not on the higher time frames, that means, okay, you can take some short profits off of there, but it's not necessarily a true trend. It's just a correction. And that works whether it's a bullish trend, provides bullish behavior, which is an uptrend. Bearish trend provides bearish behavior, which is a downtrend. So stay disciplined about the rules, and you guys are going to eliminate a lot of that exposure to yourselves in the market. Okay, so question. If price cannot make lower lows and did not go past the last low, what does that mean? Anybody? There's no one out here. Okay, so that means we're in an uptrend. If it cannot make lower lows, it didn't go past the last low, that means we have a high point and we have a higher low. It has to go higher. Same thing with downtrends. If price, now I'm gonna switch some of the words up in this question now. If price cannot make higher highs and we did not go past the last high, what does it mean? The market can only go down. So always talk to yourself and walk it through. So a lot of people, like, they always tell me, they ask me, why don't you stay for London session? London session is the best session, yada, yada. And realistically, all my trades are planned out months in advance, weeks in advance, days in advance, to where I don't have to hop from session to session. All I have to do is click on my trading view, watch for the confirmation to happen, and then execute. So if I've already done all the work of marking up my charts, I know my charts are flawless because I've been marking them up the same way for 3 years, flawlessly, effortlessly, and consistently. then I'm going to trust my charts over anything else that it says. Now, if we get hit by a freaking asteroid and everything goes berserk, and my charts still tell me to buy the fucking market, I'll buy the market because my charts don't lie, guys. And that's why I'm a successful trader. All right, so we're going to go ahead and go into supply and demand. Now, supply zones are just an area of price where seller volume occurs from historic chart prices. So when people say look left in order to go right, that's what they mean. They mean look at what the chart has done in the past, reference those areas to see what the chart will do in the future. Whether it bounces off an area and rejects from an area, or if it breaks an area and retests above an area for a buy or rejects off of a sell. Pay attention to what it has done in the past in these areas in order to predict the future. Demand areas are the opposite of supply zones. They're going to be buying areas. So they're going to be an area of price where buying volume occurs from historic chart prices. Look left to go right, whether it's a buying opportunity or a selling opportunity. That's really all there is to trading. No indicators, just looking back at historical prices, reacting from the zone breaks and retests. If you are a break and retest trader, you're going to do fantastic in these markets. I don't know how anyone else really trades without looking at just pure market structure and breaks and retests. But that's just me. Supply zones equal high zones. So high zones, like from the sky, like when it rains. If it's raining, it's not going to rain from your feet. It's going to rain from above you. That's what a supply zone. Supply zones are supplying us with price. They're supplying us with rain, so on and so forth. When an uptrend is broken by a bearish candle, a supply zone is created. So if I am in a bullish, if I'm in a bullish trend, an uptrend, and say price kind of fiddles a little bit, way up 500 pips away from where my entry price was, and I get a long bearish engulfing candle over my green candle on a higher time frame, such as maybe the daily or the weekly price, it's about time for me to get out of this trade because, okay, I can see prices trying to reverse or even temporarily throw a correction in the trade itself. So unless you're a swing trader, I don't necessarily hold corrections like that. I just always wait and set up for the best movement. And that's what it is. Like, unless you are a swing trader, it's always best to just wait for the next best opportunity. So you don't have to overexpose yourself. It only makes sense to me. Like, it doesn't make sense to me entering anywhere. Like, I had a guy the other day who was asking me about I don't know, Bitcoin or something like that. I don't know what he was. He's not one of my students. But I was like, okay, well, what's your entry and exit? He said, oh, I don't know. I just entered anywhere. It's like, well, that's the problem. You cannot just enter anywhere. Every single entry that you guys take in the market or exposing yourself to has to mean something. It has to mean something. It has to mean something. You guys get that in your head, and like, the world is yours. The money is yours. You can throw whatever lot size you want once you understand that you have to get it in your head that for every entry has to be a reason. If there is no reason, there's no entry. Demand zones or low zones. So when, say, you're walking on the ground, that's a demand zone. When, say, if there is Black Friday and there's 50 TVs and demand is high, that means people are trying to buy the price of those TVs because the price is low enough to where, like, it's getting people's attention. That's what demand zones do. So a demand zone can be broken, or a downward trend can be broken by a bullish candle out of a demand zone. So even if you're in a bearish trend and you get a long green candle and then a retest above that demand zone, then you can treat it as a demand zone. It is not a demand zone or supply zone until you get a retest. The retest is the respect. With no respect, there's no trade. No ticket, no taco, no respect, no trade. Same thing. All right, we're going to do some live examples in a bit because I'm just going to knock all the examples out and mark off a few charts with you guys at the end of the video. I don't know why I put that in the middle, but moving on. All right, so here's an example here. Oh, here it is. Here's an example of this being our base. We're on the daily time frame at this point. This being our base, we're on Euro Mexico, and at this point, our supply zone was acting as supply over here. So with supply, price, into selling opportunities, demand got investors and interested in price. So now we started buying up from our demand. As you can see, our supply area was broken by all the influx in demand and price, and then it blew through the supply, right? Now, the supply zone is not broken until it's respected. This is a respect point. This is a respect point. And this is a respect point. As long as we never go back under this supply zone, price is being respected, and we can move into bullish trend. Here, we can move into bullish trend. Had this demand zone been broken, it would have turned into a supply zone. Let's see. Okay, so here, I'm just showing you guys what it looks like when you throw a flag. A flag, a correction in price. This all means the same thing. It's about respect. I just call it all respect because respect is a very simple term that everyone knows. And if something respects price, all I'm meaning is I wanted to respect price by throwing a flag. So all these green candles is our impulse. This is a bullish impulse move. This flag here is the respect. And as you can see, after we got our respect, it never tried to touch this area again. Up here, it tried to respect it. It tried to get out of at the area. And up here, it tried to get in our area. But what were these two missing? Missing the respect. Missing the respect. So all the buyers that was up here, they got dragged down about 100 pips and blew their stops. If they were smart, they had to stop because Euro Mexican don't play. USD Mexican don't play. The people that waited for the respect to happen, they were rewarded and caught this entire trend all the way to I think like 26, 27, which is 1,000 pip trade. Correlation. So a correlation is a force pair that moves in relation similar to one another. A negative correlation is a force pair that moves inversely opposite to each other. So let's take DXY for example. DXY, so USD MXN, DXY, USD CAD, so on and so forth. All the ones with USD ... or XXX, they all correlate with each other. Negative correlations would be like USD and indices. So USD or DXY versus US 30, or USD versus NAS 100, or USD versus Great British Pound, or USD versus the Euro. Those are inversely correlated to each other. If you know what one trade is doing, what one currency pair is doing, you know what the rest are doing as well. So me personally, when I first started trading, I marked up charts all day, every day on Sundays, just so I can start looking at the structure of the market, learning how pairs will move, so on and so forth. And really, I feel like if you don't do that, if you don't play with the correlations, you're really trading blind because, you know, something may be happening in the country to where this currency pair is being affected. But if you have 12 other currency pairs that's telling you something else, then go with the other 12 currency pairs. And what one does, the others have to match. It might not match it right away, but eventually it's going to match it. So that's what I was saying. So these was just some examples of correlation. So you have DXY, USD MXN, USD CAD, USD ZAR, USD JPY, USD CHF, and USD DKK. They all move the same. They all have that USD in front of them. GBP correlation, GBP DKK, GBP USD, GBP CHF, GBP JPY, AUD CHF, NZD USD, AUD CHF, AUD JPY. These are all gonna move the same, so on and so forth. I wouldn't necessarily say play correlations all the time. I'm more of a trader to where I keep correlations in mind, and if I have one suspicion about one correlation, I'll mark up the other ones that I feel like go with it, and if they all giving me the same excuse, I find the best setup between the 10 pairs, and I execute off of the best setup. That's just me. Play that however you would like. Another correlation is Euro GBP, Euro AUD, and Euro NZD. Something that I don't have on correlations that I want to actually talk to you guys about too would be when you're measuring the strengths of currency pairs. Say if you're trying to measure USD versus GBP, what I like to do instead of, I don't know if some of you guys were trading a couple years ago, so where you guys remember that currency pair app, the heat wave that we all had back in the day, and all it was doing was measuring the currency pair for us, when in reality you can do it manually as well. So if I'm trying to measure the strength and see which currency pair is the strongest against the majors, I would measure DXY first, which represents the US dollar. I would measure that against GBP USD, because now I'm measuring GBP strength versus US dollar. Then I would measure Euro USD. So now I'm measuring the Euro versus the US dollar. Then I would measure Euro GBP. And so I'm measuring GBP versus the Euro. So now I got 4 pairs, and they're all going to either tell me the story or show me one of them's lying. Whichever one's lying and it's behind and lagging, that's the one that I'm going to take, because it's lagging. Everyone else has already shown his hand. You haven't shown your hand yet. Give me your deck of cards. That's me in the charts. So keep that in mind if you're trying to measure the strength. Measure the strength every single week, because something might be different. So we're going to talk about account management. So account management we talked about a little bit earlier, and that's going to be, you filling out the trade by putting the 0.01, not adding the initial heavy entry too soon, because you want to limit the exposure that you have to your account to pullbacks in the market, especially when dealing with baby accounts. 0.01s or baby accounts going to be your greatest strength, because say if you have $100 in an account, you start with 0.01, see where the market's going. Once you get that second or third confirmation, then you add a 30 lot, and then it moves 100 pips, boom, you got $300. But if it pulls back 20 pips on a 30-cent lot, you're going to be negative 60 of your $100, and that's no fun, guys. So scaling in is going to be important before going in heavier on the lots, especially when you're still learning too. While you're learning, you're going to be taking more pullbacks in the market. So like me now, I don't feel like I have as much pullback now, especially when I'm not just calling trades out like that. I'm not experiencing as much pullbacks as you guys, because I start with a 0.01. So even if I enter something, say GBP AUD last night, I was like, okay, I want to see how the market's moving, because I knew that today was a holiday. I also knew that the volume in the market was going to be low. So as expected, I woke up at 6 a.m., 7 a.m., saw that all of London, the trade consolidated, because there's just no volume in the market. It's Martin Luther King Jr. Day. So, I went ahead and cut the loss. And then ultimately I checked on it later in the day, probably around noon, and I saw that it shot up, and it would have stopped me out anyway, 40 pips, like a 20 pip loss on a scale in entry rather than a giant sell entry with a big lot, because that's what makes sense to me, especially knowing that the holiday was coming up. Moving your stop loss to break even points, and moving your stop losses to take profit, or stop break even, and stop losses in profit, even if it's 10 to 20 pips. Moving those stop losses is what's going to help protect your capital, guys, because the reason we're in this game is to protect our capital. With no capital in there that you can't protect, you just have to keep depositing money. And me personally, it doesn't make sense to me to be continuously depositing money into the markets, because we're supposed to be coming out with money. We're not paying them to lose money. Like, if you keep depositing money, all you're doing is paying these people. I'm not giving them nothing. I'm giving them crap, nothing. They're going to pay me. So protect your capital. That's the name of the game. Even if, I don't know why some of y'all do this, but I think some of y'all will get into a trade. It'll probably go up 50 pips, putting a stop loss at break even, or moving it even into profit once it hits the 30 pip mark. And then sometimes, depending on the market, you can't control the volatility of the market. You can't control you can control trying not to get stopped out, but really all it's doing is hurting you, because all you're doing is moving your stop. The stop has to stay, the take profit has to stay, and your entry is already staying. You can't change your entry, but protect yourself. don't move your stop loss, because you keep moving your stop loss and ultimately you just suffer a bigger loss than you would have if you left it alone. Like, I think some of you guys try to prevent getting stopped out, and ultimately you burn yourself out because you have to continuously deposit money because you're trying so hard to avoid getting stopped out, when really being stopped out is what was going to save your account, whether the stop loss was in profit or at a break even point, or just even a 25 pip stop loss negative. Like, a break even stop loss means you need to move your stop loss to your entry point so that the trade becomes risk free. A stop loss in profit means your stop loss is above your entry point, so that even if the market pulls back, you're not losing any money. All you're doing is holding the trade until you have reached the point of income coming in, to where you're like, okay, I can take profit now. I'm up like $700, $7,000. I can take profit. It's cool. 25 pip regular stop loss, even if it's negative, just means you won't have 100 pip stop loss. I don't really know how else to explain that one, guys. But that's part of the basics. The basics you can find on babypips.com. I'm not necessarily going into the basics because this is an advanced course for everyone. But protect your capital is the moral of the story. Long story short. All right. So, trying to get a pretty long video. So we're going to talk a little bit about psychology. And this is just stuff that really should be second nature to you guys. So you never want to react off the first touch. You want to react off the second or third touch, because the second or third touch is going to give you more confirmation. Typically, if price touches the supply zone on the first touch and you're expecting it to break it, it's not going to break it on that first touch to the area. It's going to get a rejection from the supply zone. Same thing with demand. If you get that first touch to a demand zone and you're expecting to buy, you may not get the buy off of the first touch on the demand zone. You might get it on the second or third touch. So pay attention to that. Never sell in an uptrend. Always look for buying opportunities, because that's really is what smarts to me. Like, if you're in an uptrend, that means buying. So why would I continue to try to sell an uptrend? And that's actually what got me this morning, guys. Like, I did it too. Like, I still make the same mistakes you guys make. Now think about it. GBP is bullish because USD is selling. My ass was over here trying to sell GBP AUD, right? It don't make no sense. And that's why I realized this morning, I'm like, I don't know why I'm trying to sell GBP. Like, obviously, it consolidated all night long. And ultimately, I probably could have got out at break even, but I held it just a little bit longer to see if it was going to go into profit. And then it shot up one last third time. And I was like, you know what? I'm going to take a 20 pip loss, because I know that GBP is bullish. And that's just me just being subjective to the market. I know GBP is bullish. There's really no reason for me to be selling it other than I wanted to try to get in at a better buying price. I wanted it to touch my demand zone one more time, and the market just didn't want to go for it. But that's a part of the game, guys. We have to do and go where the market wants to go. Like, we can't force the market to do anything, but that's just the way that I feel. Never buy a downtrend. So in a downtrend, you should really be only looking for sales. That means you're supposed to be selling at lower highs. So the highest point in a downtrend is where you need to be selling. Don't be buying just because you see all these bullish candles, unless you get a flat confirmation that tells you to buy and that the trend is changing. Notice the trend is changing, then I would not buy a downtrend. I would not sell an uptrend. A real uptrend, like I said earlier, will never give you a lower low, and a real downtrend will never give you a higher high. So I want you guys to remember that the greatest enemy in the market is yourself. And the only one who can stop you from being successful is yourself. Like, realistically, you guys can have all the right trades and all the right entry points, but if you cannot get out of your own head and stop fidgeting with the trades, so on and so forth, and just look at it for 27 days in a row, ultimately you're going to lose anyway. And that's just the name of the game. So, me personally, I go on YouTube, I start reading books like The Alchemist. I start reading The Disciplined Trader. I read Naked Forex. I just start trying to get my mind in a point to where my mind's not playing tricks to me. Like, I even got to a point to where probably I stopped watching the news 2 years ago, because I could tell that watching the news was only messing with my trading. So my trading got a lot better once I cut out that news aspect. I wasn't watching the trade wars. I wasn't watching anything that had to do with Corona, because ultimately the news is there to scare you guys. Like, it's not there to do you any good, because if the news was there to do you any good, everyone would be more successful than they are now, right?